Hello students, today we are going to study about the topic called partnership fundamental. Now, before we start with the topic, I would request you to have your notebook and a pen so that you can take note of all the important points which I am mentioning while explaining this topic called partnership fundamental. This chapter, if you know partnership fundamental very nicely, your further chapters become very easy, which are very much related to the basic concepts of the knowledge that we learn in this chapter. Okay, so now before we begin with the next, first you need to understand that what is partnership business. Partnership business is the business which is formed when the two partners come together and enter into a business. So when two or more partners enter into a business, they form an agreement called partnership deed. Now, these partnership deeds have all different clauses, different rules mentioned. We are not going further in the details of that part, but when this partnership deed is not made, or when this partnership deed in the question is said it is silent, then what you are supposed to do? This is very important, students. If in the question it is mentioned that partnership deed is not made or partnership deed is silent, then how you are supposed to deal with it? If in the question it says that partnership deed is not made or partnership deed is silent, we will follow the rules mentioned in Indian Partnership Act 1932. Again I repeat, if in the question it is said the partnership deed is not made or partnership deed is silent, then you will follow the rules according to Indian Partnership Act 1932 applies. Now let us study what are the rules that are applicable for Indian Partnership Act 1932. These are the different rules which are framed under Indian Partnership Act 1932, which we need to follow if in the question it is silent that partnership deed is not made or there is no partnership deed agreement being formed between the partners. Now what are these rules that are specified under this act? Let us study that. First is profit sharing ratio. Now if the question says that the profit sharing ratio is not mentioned because of the partnership deed being silent, or even if the profit sharing ratio is there in the question but partnership deed is silent, that word is mentioned in the question, then also you will share the profits between the partners equally. Remember, if partnership deed is silent, we follow this rule regarding profit sharing ratio, how the profit will be shared between the partners equally. Interest on capital. Interest on capital, yes, definitely partners get interest on capital because all the partners have contributed certain capital into their business to form a partnership business. So in return, a company gives them interest amount for their capital that is invested. So for that, interest on capital is also not allowed. Interest on drawings, when we talk about interest on drawings, is when any partner withdraw certain money from the company for personal use, then company charge interest on drawings from the partner, so that is also not to be charged. Interest on capital is an expense for a company. Interest on drawing is a revenue for the company. When I talk about partnership salary, commission, etc., these are the different benefits which are given to the partners. They are also not to be allowed. When I talk about interest on loan given by a partner to the firm, sometimes what happens? Partners give loan to their own company. So in that case, the interest is to be given by the firm to the partner because firm has taken a loan money from the partner. So for that, what is the percentage that the interest which the firm will be giving to the partner? It will be 6% per annum. Admission of a new partner. When the new partner is going to get admitted into partnership business, Unless and until all the partner agrees, the new partner cannot be admitted. Suppose there are three partners A, B and C, and D is the new partner which they want to admit. If B and C agrees to it, but A is not agreeing on admission of a partner called D, then the D partner cannot join into a business to form a partnership along with A, B and C, because the condition according to Act 1932 says that all the partners should agree to bring in to the new partner. Let us me show you some examples which are there for partnership deed is silent. Now these are different examples which I am mentioning where partnership deed is silent. There are many more. I am just presenting you the few examples. Suppose if in the question says partnership deed is silent, I am giving you one situation. Amar, a partner, has contributed more capital into the firm. So he is demanding interest on capital at 10% per annum. But other partners B and C is not agreeing into that. Why? Because partnership deed is silent. So yes, B and C is correct, right? Because in absence of partnership deed, no interest on capital is allowed to any partner. So A, Amar, that cannot get any interest on capital because he, though even giving the more amount of capital into the business, his interest on capital cannot be given at 10% per annum because partnership deed is silent. None of the partner, in fact B and C will also not get interest on capital. Okay, let's go with the another example. C demands interest on loan of rupees 50,000 advanced by him to the firm. So here C is giving a loan of rupees 50,000 to the firm at market rate interest, which is 12% per annum. He wants that. So will he get 12% per annum interest from the company? No, because partnership deed is silent. It's not mentioning anything about that. So we'll follow Indian Partnership Act 1932 rules, which says interest on C loan is payable at 6% per annum only. So let me revise again with you all the rules which says according to the Indian Partnership Act 1932, yes, that profit and losses to be shared equally, interest on capital not allowed, interest on drawings not to be charged, partner salary and commission, yes, it's not to be allowed, interest on loan, if any loan partner has given to the firm, then what interest rate he will be given by the company, he will get at a 6% per annum income from the company because C partner has given loan to the firm. Now, interest on loan by the partner to the firm. So, who has given loan? Partner has given loan to the firm. So, when a partner gives loan to the firm, here who is going to get interest? Firm is going to give interest to partner. So, partner will get an income of this interest because partner has given loan to the firm. So let us understand what are the different entries or the aspects that we need to know under this case. Since loan is advanced by a partner to the firm, partner has given loan to the firm, right? So for the firm, what is it? It is definitely a liability for the firm. So it is credited to which account? To partner's loan account. Remember, when a firm takes a loan from the partner, firm has to return that money back to the partner. So definitely it is a liability, and for that company opens a separate account called partners loan account, and it is shown as liability in where in your balance sheet. It is a charge against profit and debited to profit and loss account. What is charge against profit? The interest amount which the company have to give to the partner, because company have taken loan from the partner. So that interest which the company will be giving to the partner because they have taken loan, that is charge against profit, and it reflects in which account? In your profit and loss account, in on your debit side. Okay, now coming to the two effect of the entries, adjusting entry and closing entry. What do you understand by adjusting entry? Adjusting entry means you are adjusting an account to a particular of its nature, right? When you are saying closing entry, that means any nominal account we close at the end of the financial year, either by transferring them to trading account or to profit and loss account. Now when I talk about adjusting entry, interest on partner's loan account debit to partner's loan account, that's the adjusting entry. Yes, why interest on partner's loan account debit is coming on the debit side? Because it's an expense for the firm, and you very well know the golden rule, expense increases, it goes on the debit side. To partners loan account, why it is coming on the credit side? Because it's a liability for the firm, and liability increases, it goes on the credit side. If your interest is due, then you will write to partners loan account. But if your interest is not due, it is already paid, then you don't write to partners loan account. What you will write? To bank account. What will be its closing entry? Closing entry will be profit and loss account debit to interest on partner's loan account, because this is an expense. An expense goes in your profit and loss account which side? On your debit side. So the entry will be profit and loss account debit to interest on partner's loan account. So remember, this is which interest I am talking about? Interest which a firm will be paying to the partner. Why? Because firm has taken loan from the partner. So that's why we are opening a separate account called partner's loan account. Now, what if any interest on loan by firm to the partner? So it's just the opposite situation of what we have learned previously. If suppose any loan company have given to the partner, okay, here company has not taken any loan from the partner. Instead of that, company is giving a loan to the partner. So any loan which is advanced by a part firm to a partner, what it will be? It will be an asset for the firm, because it is then debited to the partner's capital / current account. Here, this loan amount is given by the firm to the partner. So, later on, firm will recover that loan from the partner, right? So, how will they recover? Here, they will not open a separate account called partner's loan account, okay? So, how they will recover that money from the partner? By against their capital or current account. Now, what is this capital / current account? This I'll explain you after few classes. Okay, so just now remember, any loan which the company have to recover from the partner, it is always recovered from which account? From partner's capital / current account. And where it is shown, if this loan is being taken by the partner from the firm, if the partner has taken any loan from the firm, so obviously for the firm it is not a liability, it is an asset. So it is a gain for the firm and it is credited to profit and loss account. So the loan amount is shown in the asset side of the balance sheet as loan to a partner account, and the interest which is the gain for the firm here, because here the firm will not be paying in interest, here the partner will be paying the interest to the firm. So this interest is gain for the firm and it is credited to which account? Profit and loss account. An adjusting entry will be partner's capital / current account debit to interest on loan to partner's account. So here we don't open any account called partner's loan account. Remember that. Here all the loan amount gets adjusted to concerned partner's capital or current account. What will be the closing entry? Interest on loan to partner's account debit to profit and loss account. Why partner's capital or current account is going on the debit side? Because the capital balance of the partner is getting reduced, because the money will be recovered from the partner account, and partner's capital is what by nature? It's a liability, and when liability decreases, it goes in your journal entry debit side. Interest on loan to partner, why it is coming on the credit side? Because it is a gain for the firm. And when we talk about closing entry, yes, definitely all the income goes to your PL account. Which side? Credit side. So this is the closing entry for it. So till now we learned the two aspects of interest on loan. One loan which a partner takes from the firm, and another loan which a partner gives to the firm. Now if suppose any rent paid or due to the partner, sometimes what happens, a company may use a personal property of the partner. So in that case the company have to pay rent to the partner. So that is again a charge against profit, and it has to be debited to which account? Profit and loss account. So the adjusting entry is rent account debit to partner's capital / current account if the rent is due, and if the rent is paid, it will be to bank account. Closing entry will be what? Profit and loss account debit to rent account. Now here why rent is coming on the debit side? Because rent is an expense. And why partner's capital current account is coming on the credit side? Because here liability is increasing and it's an expense, so the entry is profit and loss account debit to rent account. Now what is profit and loss appropriation account? Again I'll repeat, it is an extension of profit and loss account. Now why I'll say it is an extension of profit and loss account? Normally in a partnership business, they make trading account, profit and loss account, and after profit and loss account, they make profit and loss appropriation account. But when it comes to normal sole proprietorship form of business, as you have already studied in your 11th standard, we had made trading account, profit and loss account, and balance sheet. But when partnership business is there, they make trading account, profit and loss account, profit and loss appropriation account, and balance sheet. So after PL account, we make an account called profit and loss appropriation account. It is prepared by only partnership form of business, okay? And it shows what? It shows how profit is distributed or appropriated among partners. So it does not show us any expense or revenue. Remember, it just shows how the profit or the net profit of the business that you earn after determining your different revenue and expense. When you make your profit and loss account, the net profit that you derive, how you distribute that net profit among the partners. So that is what is reflected in profit and loss appropriation account. So remember, that's why we need necessary to use this word called appropriation account. Now, the main difference between profit and loss and profit and loss appropriation account. It's very important to know, students. Now, what is profit and loss account? You know, always it is prepared after your trading account. We prepare when profit and loss account? After trading account. Therefore, it starts with your gross profit on your credit side, and if you have a gross loss, it starts on the debit side as per the trading account information. But when is this prepared profit and loss appropriation account? It is prepared after profit and loss account. Therefore, it always starts with the net profit in the credit side or the net loss in the debit side as per the profit and loss account. What is the objective? Why we prepare profit and loss account? To find what? To find your net profit or net loss, whatever you have earned in a particular accounting year. But why we make PL appropriation account? To show how we are appropriating or distributing our net profit or net loss of our company. Normally, remember, PL appropriation is made only if your company is showing a net profit. If there is a net loss, we don't make profit and loss appropriation account. We make only profit and loss account. But there are one or two exceptions which I'll tell you during the sums. Nature of item. What type of items do we post in PL account? We post all the expenses and the income. Expenses which are charged against profit, but Here there is no charge against profit, there are no expenses or income. There are an items which are to be appropriated. Now what is this word appropriated that I'm using every time? It is just to show the distribution of the profits that you are, how you are giving to the partners who are there in the business. For example, there is a net profit of 1 lakh. Now, I may give salary to the partner, I may give interest on capital to the partner. So, it is basically this profit which gets distributed among the partners in a different form by giving them salary, interest on capital, commission, and all. Okay, even interest on drawings is being given by the partner to the firm. So what are the entries that are recorded here? All that will be doing in the next class. Partnership deed or the agreement. Do we follow the partnership deed or the agreement? No. While PL account, there is no guidance to be followed for partnership deed or agreement. But yes, when we are following PL appropriation account, we follow all the rules which are applicable or which are guided by the partnership deed or the agreement. Which matching principle concept based on which we make PL account? We follow matching principle, which says clearly all the revenue needs to be matched against the expense. But when I talk about PL appropriation account, we do not follow any matching principle rule. So that's why there is no expense or no revenue that we follow to find any profit. It is just to show how the profit of the firm gets distributed among the partners. This is all for today. So next class we will learn further beyond that how to pass all the necessary adjusting and the closing entry. What are the things, what are the items that comes on your PL appropriation account, and complete making of it with your numericals. Thank you.